Most financial collapses don't begin with recklessness. They begin with comfort, the kind that grows out of routine, out of steady paychecks, out of the quiet belief that the risky years are behind you. This story starts in a year that looked normal. Bills were paid on time, work showed up every morning, life felt predictable, and that's exactly why no one saw the fall coming. This story is about Andrew Collins. He's 42 years old, lives in suburban Ohio, married, 2 kids, a mortgage, 2 cars, weekend soccer games. Andrew worked as an operations manager for a mid-sized manufacturing company. Nothing flashy, nothing fragile. Household income sat around $95,000 a year. Enough to feel solid, enough to stop worrying. Andrew wasn't reckless with money. He didn't gamble. He didn't chase luxury. But he trusted his income, and that trust shaped every decision that followed. The spending wasn't wild, it was quiet. A bigger grocery run because prices kept creeping. A newer phone when the old one suddenly develops a fault. A few subscriptions that stayed because canceling them felt unnecessary. Credit cards filled the gaps. Not because Andrew was careless, because cash flow still worked. Minimum payments cleared. Balances stayed manageable. Andrew felt stable. Then came the first crack, a restructuring announcement at work. Not alarming, just changes. A few months later, the meeting arrived. His role was eliminated. No scandal, no warning signs he could point to. Just a quiet end to a long routine. At first, Andrew stayed calm. Severance came through. He had some savings. They weren't large, but they helped. He told himself it was temporary. That belief is powerful. It turns pressure into patience, and patience leads to delay. Bills didn't stop. Mortgage, insurance, groceries. The credit card stepped in. According to Experian, average U.S. credit card APRs now sit above 20%. That number sounds abstract until it starts working against you. At first, Andrew didn't feel it. Interest rarely announces itself when it begins. The minimum payments went through. Balances stayed within a manageable range. Nothing bounced, nothing broke. Andrew stayed focused on what felt urgent. Job applications, follow-ups, interviews that seemed promising until they weren't. The debt lived quietly in the background. That's how revolving balances work. They don't interrupt your day, they wait. Then the year shifted. The severance ran out without ceremony. No final alert, no moment of warning. 1 month it was there, the next it wasn't. Interviews slowed, responses took longer, silence stretched. Andrew told himself this was still temporary. Those things would line up soon. Then something small happened. A repair, not catastrophic, just inconvenient. A bill that didn't fit the plan he had rehearsed in his head. The credit card filled the gap. Again. This is where interest begins to matter. Because 20% doesn't hurt all at once. It compounds quietly. Each month the balance stayed. It grew. It didn't jump up, but it kept increasing. And each minimum payment barely slowed it down. Andrew didn't see a spike. He saw stability. That illusion is dangerous. Because when debt feels stable, it feels controlled. And when it feels controlled, it stops feeling urgent. But the math never relaxes. Income had stopped. Interest hadn't. By the time Andrew noticed the numbers weren't shrinking anymore, they had already changed shape. He wasn't paying down. He was renting it. That's the moment most people miss. Not the crisis, the quiet shift before it. When the bill is still getting paid, but the future has already been sold forward, month by month. And Andrew was only beginning to feel it. A car repair, then another. This is where behavior changes, not dramatically, quietly. Andrew stopped checking balances as often, not because he didn't care, because the numbers made his chest tighten. That's cash flow stress. When money math turns emotional, decisions speed up. Groceries went on cards, gas went on cards, small things stacked. Making minimum payments kept things calm, at least emotionally. But the math was working against him. Interest compounds monthly, income didn't. By the time Andrew found another job, the damage was already built in. Lower pay, higher debt, less flexibility. This is the moment many families miss. They think the crisis is over because income returns. But debt doesn't reset when paychecks do. The bills were heavier now. The margin is thinner. Every dollar had history attached to it. Andrew felt like he was falling behind. He wasn't broke, but he felt trapped. Have you ever felt like the worst part wasn't the setback, but what lingered after? Yes or no? The pressure showed up everywhere. Arguments over groceries, guilt over small purchases, silence around money. This wasn't about numbers anymore. It was about identity. Andrew had always seen himself as responsible, and now it felt like the system he trusted had failed him. But here's the truth most people never hear. One bad year doesn't destroy finances. Delayed decisions do. Andrew didn't collapse because he lost his job. That was just the trigger. What actually broke him was what came after. Realizing his money had no shock absorbers, no buffer, no room to bend. The system worked only when everything worked. Paychecks came in, bills went out. As long as life stayed predictable, the structure held. But the moment life shifted, the structure showed its limits. The turning point didn't arrive with clarity or confidence. It arrived with fatigue, the kind that settles in your shoulders, the kind that makes you stop pretending tomorrow will fix today. One night after the house had gone quiet, Andrew sat alone at the kitchen table. No TV, no phone buzzing. Just the hum of the refrigerator and a stack of unopened mail. He didn't sit down to solve anything. He sat down because he was tired of avoiding it. He opened every statement, one by one. No skipping pages, no rounding numbers down in his head, no telling himself it would look better next month. Just the numbers as they were. Balances, interest rates, minimum payments. The math didn't accuse him, it didn't judge. It just existed, and that made it harder to ignore. This was the first moment Andrew truly stepped back from the noise, from the panic, from the cycle of reacting. He saw how interest worked while he slept, how minimum payments barely touched the balance. Every month he carried debt, and it quietly claimed more of the future. This wasn't about mistakes, it was about momentum, bad momentum. One of the kind that builds slowly and then feels impossible to stop. Andrew noticed something else. There was no single disaster on the page, no outrageous purchase, no reckless choice, just accumulation. Small decisions stacked under pressure, delays that felt reasonable at the time. Trust was placed in stability that didn't last. This is the moment most people never reach. Not because they can't, because it's uncomfortable. Looking at numbers without flinching takes energy, and energy is the first thing pressure drains. But that night, Andrew stayed. He didn't fix anything yet. He didn't make promises. He just looked. And in that stillness, something shifted. Not hope, not relief, ownership. For the first time in months, the money wasn't chasing him. He was facing it. That didn't erase the damage, but it stopped the freefall. Because recovery doesn't start with a plan. It starts when avoidance ends. And for Andrew, that night at the kitchen table wasn't about solving his finances. It was about finally standing still long enough to see where he actually was. He saw how interest was eating into future income. Opportunity cost showed up clearly. Every dollar paying interest was a dollar not rebuilding stability. This is where recovery actually begins. Not with motivation, with clarity. Andrew didn't chase hacks. He rebuilt the structure. He froze his credit cards by physically putting them away. Not out of punishment, out of protection, he sequenced debt payoff. Highest interest first, he rebuilt savings slowly, even in small amounts. According to the CFPB, households that rebuild emergency buffers after financial shocks recover faster and carry less long-term debt. Andrew felt that shift, not freedom, control. Progress was slow, but visible. The pressure eased, not because he suddenly had more money, but because it stopped slipping away. This is the part people don't talk about. Recovery isn't exciting, it's boring, and boring is powerful. Andrew didn't become wealthy, he became stable, and stability changes everything. He stopped fearing statements, stopped avoiding conversations, stopped reacting. One bad year didn't define him, but it taught him something permanent. Income is not protection, structure is. Debt doesn't care why you needed it, only how long you keep it. And financial freedom doesn't come from never making mistakes. It comes from building systems that catch you when you do. Money, if you've ever felt one bad year away from losing control, you're not alone. And if this story felt close, that's not a coincidence. We post real finance stories every day. Subscribe so you don't miss the next one. Share this with someone who needs to hear it. Catch you in the next story.